You've found the person you want to build a life with, and now you've found the place you want to build that life in. Deciding to buy a home together is a huge, exciting milestone. But amidst the Pinterest boards and open house tour, there's a conversation that many couples put off or avoid entirely because it feels unromantic or confrontational. That conversation is about the legal and financial reality of a joint mortgage. This isn't just about qualifying for a bigger loan together. This is about merging your financial destinies in one of the most binding ways possible outside of marriage. A mortgage lender will see you as a single financial unit, but your personal relationship operates under different rules. What happens if one of you loses your job? What if you split up? What if one person contributed 70% of the down payment? Without clear answers, these questions can turn a dream home into a financial and emotional nightmare. This guide is your roadmap for having those essential conversations before you sign the closing papers. We'll walk through the financial mechanics of applying together the critical legal distinctions in how you hold title and why a formal written agreement is not a sign of distrust, but the ultimate act of care and protection for both of you. Let's build a foundation as strong as the house you're buying. Let's start with the financial mechanics. When you apply for a mortgage jointly, the lender will consider both of your financial profiles. They will pull credit reports and scores for each of you. Typically, they will use the lower middle score of the two borrowers to determine the interest rate and terms. So if your scores are 780 and 640, you'll be priced as if you both have a 640 score, which means a higher interest rate. This is a crucial point to discuss upfront. Can the higher scored partner qualify for the loan comfortably on their own? Sometimes, it might make more financial sense for only one person to apply, using only their income and credit to secure a better rate, even if it means qualifying for a slightly smaller loan. However, using both incomes will increase the amount you qualify for by lowering your collective debt-to-income DTI ratio. All income, assets, and debts from both applicants are combined. This can be a double-edged sword. Your partner's stellar income helps, but their student loan or car payment also becomes your debt in the eyes of the lender. You must both be fully transparent about your finances long before the application. No surprises. Now we move to the most important legal concept in a joint purchase: how you hold title. This is specified on the deed and dictates your ownership rights and what happens if one of you dies or if you sell. There are two primary ways for couples. The first is joint tenancy with right of survivorship. This means you own the property 50-50, it's indivisibly. If one partner dies, their share automatically and immediately transfers to the surviving partner by passing probate. It's simple and common for married couples. The second is tenancy in common. This allows for unequal ownership percentages. You could own 70% and your partner 30%, reflecting an unequal down payment. Each owner can sell or will their share independently to someone else. There is no automatic survivorship. If one owner dies, their share goes to their heirs, not necessarily the other owner. For unmarried couples, tenancy in common is often recommended because it allows for a more nuanced, contractual reflection of your financial contributions. Deciding this is not a casual checkbox. It requires serious discussion and should be guided by a real estate attorney. This leads us to the single most important document for unmarried couples buying a home together: a cohabitation property agreement or partnership agreement. This is not a romantic document. It's a business contract for your shared asset. It outlines in explicit detail what you've both agreed to. A comprehensive agreement should answer: what percentage of the down payment did each contribute? How will monthly mortgage payments, property taxes, insurance, and maintenance costs be split? Is it 50-50ths or proportional to income or ownership share? How will you handle capital improvements like a new roof, and will that affect ownership percentages? Critically, it must have a buy-sell agreement or exit clause. What happens if you break up? Does one person have the right to buy the other out? How will the home's value be determined and appraisal? What is the timeline for this process? What if you both want to sell? How will proceeds be divided after paying off the mortgage and closing costs, factoring in your initial contributions? Having this difficult conversation and putting it in writing while you are on good terms is the only way to ensure a fair and orderly process during an emotionally charged separation. It protects both of you. Even for married couples, a clear understanding is vital, though your state's divorce laws will govern a split. However, you should still discuss and document any significant separate property contributions, like using an inheritance from one side of the family for the down payment to ensure those funds are treated as intended in the future. A pro tip for unequal contributions: if one partner is providing the bulk of the down payment, consider structuring the loan so that partner is the sole borrower on the mortgage note, taking on the legal debt while both partners are still on the deed as owners. This is complex and requires legal advice, but it can protect the contributing partner's financial stake. However, the non-borrowing partner's income then cannot be used to qualify for the loan. Day-to-day, you need a system. Open a joint checking account dedicated solely to home expenses. Each partner contributes their agreed-upon share monthly via automatic transfer. All mortgage payments, utility bills, and repair costs are paid from this account. This creates transparency, avoids resentment over who paid for what, and makes accounting simple. Also, ensure you both have adequate life insurance policies with the other named as beneficiary, enough to pay off the mortgage or buy out the other as share in the event of a tragedy. This is a non-negotiable part of responsible joint ownership. In conclusion, a joint mortgage is a powerful tool that allows you to build wealth together, but it must be approached with the seriousness of a business merger. The three pillars are financial transparency, know each other's credit and debt, legal clarity, choose the right form of title, and draft a cohabitation agreement, and operational system, create a joint account and a plan for expenses. Having the hard conversations now is an act of love and respect. It ensures that your shared investment supports your relationship rather than becoming a source of conflict. It allows you to move forward in your beautiful new home with confidence, security, and peace of mind. If this guide helped you see the full picture, subscribe for more advice on building a secure financial life. Next, we lines explore the external force that affects every mortgage holder, the impact of changing interest rates. Now, sit down with your partner, open a document, and start drafting your agreement. Your future selves will be grateful you did.